A few weeks ago, a woman in Pennsylvania sat at a closing table ready to sign the paperwork for a new home. The mortgage was a 30-year fixed loan at 6.8%. She looked at the lender and asked a simple question. Who decided it should be 6.8%? The lender smiled and gave the standard industry answer. That's just where rates are these days. But that's not really an answer. It's a polite way of saying, I don't want to explain the machine behind the number. So here's the real explanation. That rate wasn't chosen by the bank. It wasn't personally chosen by the Federal Reserve. It was largely determined by a financial market most people never think about. A market worth roughly $150 trillion, larger than all global stock markets combined. That market influences your mortgage payment, your car loan, your landlord's borrowing costs, your employer's ability to raise capital, and whether supposedly safe retirement investments suddenly lose significant value. This isn't a story about some obscure investment reserved for wealthy people. It's about the invisible engine quietly pricing almost every financial decision in your life. And I've spent far too many hours studying a market that is somehow less exciting than watching paint dry, but significantly more important. If you've ever wondered why borrowing money suddenly became expensive, or why conservative investments stopped feeling so safe, subscribe now. By the end of this video, you'll understand a major part of the financial system better than many people who spent years studying it professionally. And honestly, that's more criticism of finance education than praise for you. Let's start with the simplest explanation possible, because people love making this topic sound far more complicated than it actually is. A bond is basically an IOU. That's it. Someone needs money, maybe it's a government, maybe it's a corporation. Sometimes it's a city trying to finance a project that probably didn't need approval in the first place. Instead of borrowing from a bank, they borrow directly from investors. You hand over, let's say, $1,000. In return, they promise two things. First, they'll pay you interest every year. That's called the coupon. Second, they'll return your original $1,000 on a specific future date. That's called maturity. When the U.S. government spends more than it collects, which happens constantly, it issues treasury bonds. When companies like Apple want access to capital, they issue corporate bonds. When financially weaker companies borrow money, Wall Street calls those high-yield bonds. Years ago, people simply called them junk bonds, but apparently that wasn't marketing-friendly enough. Now here's the part almost everyone gets wrong, and it's probably the most important concept in this entire discussion. Imagine you buy a $1,000 bond paying 2%. That means you're earning $20 per year. Not exciting, not life-changing, just $20. Now imagine a year passes and interest rates increase. New bonds are being issued. Same borrower, same $1,000 investment. Except now they're paying 5%, which means $50 per year. So here's the question. Who wants your old bond? You walk up to an investor and say, "Would you like this bond that pays $20 annually?" The investor looks at you and says, "Why would I buy that when I can get $50 from a brand new one?" Your bond hasn't broken, nothing changed about it, it's still delivering exactly what was promised. But suddenly, it's the financial equivalent of an outdated smartphone, functional but no longer worth full price. The only way you're selling it is by lowering the price enough that the fixed $20 payment produces a competitive return for the next buyer, which means your $1,000 bond might suddenly trade somewhere in the $700 range. Congratulations, your supposedly safe investment just lost hundreds of dollars in market value. Maybe only on paper, but as history repeatedly demonstrates, losses on paper have destroyed careers, collapsed financial institutions, and even contributed to political crises. So remember this rule. When interest rates rise, existing bond prices fall. When interest rates fall, existing bond prices rise. They're opposite ends of the same seesaw. Every major financial event we're about to discuss is basically this rule playing out on a larger scale, and nowhere is it more important than a single number that quietly influences your entire financial life.
If visitors from another planet landed tomorrow and asked to see the one number that drives much of the American economy, you probably wouldn't show them the stock market. You'd show them the yield on the 10-year U.S. Treasury. Today, it's hovering around roughly 4.6%. And even if you've never purchased a bond in your life, that number matters to you. Because when a bank offers you a mortgage, it doesn't randomly invent an interest rate. The bank first looks at the 10-year Treasury and asks itself a simple question. Why lend money to a stranger for decades when we can lend it to the U.S. government and earn 4.6% with extremely low risk? The answer is obvious. They won't unless you pay them more. So the bank takes the Treasury yield and adds additional percentage points to compensate for risk, uncertainty, operating costs, and the possibility that borrowers run into financial trouble. That's how mortgage rates are largely built. A Treasury yield near 4.6%, mortgage rates around 6.8%. That's not an accident. It's not the exact formula, but it's one of the biggest ingredients. Back in early 2021, the 10-year Treasury traded near 1%. Mortgage rates fell to around 2.7%, the lowest levels many Americans had ever seen. People borrowed aggressively, housing prices surged nearly 20% in a single year, compared to a long-term average closer to 4%. Then Treasury yields started climbing. Mortgage rates eventually pushed above 8% during late 2023, and suddenly the housing market looked like someone had pressed pause. Transactions slowed, buyers disappeared, sellers hesitated. The bank wasn't the primary force behind that change, the bond market was. And the influence doesn't stop with housing. Vehicle loans, credit cards, student loan refinancing, business borrowing. Almost every major form of debt eventually traces back to the same invisible machine.
The interest rate your city pays to build a new school, the rate your employer pays to finance expansion plans, all of it ultimately traces back to Treasury yields. When Treasury yields move higher, virtually every borrower in America feels the impact at the same time. Companies that locked in cheap 3% debt during 2021 suddenly found themselves refinancing at 7%. And when your borrowing costs double, you don't simply post a frustrated message online, you cut expenses. And cutting expenses is often corporate language for layoffs. A meaningful portion of the job losses seen throughout 2023 and 2024 weren't really caused by collapsing demand. They were caused by the bond market quietly repricing debt across the entire economy. And here's another incredible trick the bond market performs. It has a better record predicting recessions than almost any economist. Normally, lending money for 10 years pays a higher interest rate than lending it for 2 years. Longer commitment, higher reward. That's how it's supposed to work. But every so often, that relationship flips. Short-term bonds start paying more than long-term bonds. This is called an inverted yield curve, and it usually signals that investors are becoming extremely nervous about the future and are rushing toward long-term safety. Economists at the Federal Reserve studied the historical record and found that this signal successfully predicted every U.S. recession since 1955 with only one false alarm. 9 correct calls and a single mistake. Most fortune tellers would dream of that kind of accuracy. While television commentators debate headlines and emotions, the bond market quietly signals that economic trouble may be approaching, and more often than not, it ends up being right. That's why political strategist James Carville once joked that he used to want to come back as the president or the pope, but later decided he'd rather be reincarnated as the bond market because then he could intimidate everyone. He wasn't entirely kidding. In a few minutes, you'll see how the bond market effectively forced an entire government into crisis in just a matter of weeks. But before we get there, we need to destroy one of the biggest myths in personal finance. For decades, financial advisors, retirement brochures, and investment firms repeated the same message. Stocks are the risky part of your portfolio, bonds are the safe part. The classic formula became 60% stocks for growth and 40% bonds for protection. Then 2022 arrived, and the protection failed.
The Federal Reserve raised interest rates from nearly 0 to above 4% in just 9 months to fight inflation. And remember the rule we've already learned: when rates rise, existing bond prices fall. The broad U.S. bond market dropped roughly 13% that year, the worst performance since records began in 1976. Long-term Treasury bonds, often considered the safest assets in the world, were hit even harder. Long-duration zero-coupon Treasuries lost approximately 39.2% during 2022. One analyst reviewed centuries of records and discovered it was the worst year for those bonds since 1754. Not 1954, 1754. America didn't even exist yet, and bonds had never suffered a decline that severe. The famous 60-40 retirement portfolio lost around 17% because for the first time in decades, bonds didn't offset stock losses, they amplified them. Millions of retirees opened their account statements expecting stability and discovered the supposedly safe portion of their portfolio was leading the decline. So were investors misled? In some ways, yes, but the reality is more complicated. Bonds protect against one particular risk: the borrower failing to repay you. The U.S. government is extraordinarily unlikely to default, but there are other risks. Inflation slowly erodes the purchasing power of fixed payments, and then there's interest rate risk, which is the risk we've been discussing throughout this video. There's actually a measurement for this. It's called duration, and it may be the most important financial concept most people have never heard. In simple terms, duration estimates how much a bond's price changes when interest rates move. A bond fund with a duration of 6 will typically lose about 6% if rates rise by 1 percentage point. A long-term Treasury fund with a duration of 17 could lose roughly 17% for the same move. In 2022, rates climbed more than 4 percentage points. Suddenly, conservative bond funds started behaving like volatile technology stocks, except without the exciting growth stories. And this is where the story becomes dramatic, because the same mathematical relationship started knocking down larger and larger targets. First, a major bank, then an entire nation. Let's follow the chain reaction. The first domino was Silicon Valley Bank in March 2023. During the technology boom, SVB received massive amounts of deposits and invested more than $91 billion into long-term bonds, with an average duration close to 6 years. These were considered safe assets. Then, interest rates surged. Following the rule you now understand, those bonds quietly lost over $15 billion in value. The bank wasn't speculating on cryptocurrencies or risky stocks. It simply bought extremely safe assets at the wrong moment and funded them with deposits that customers could withdraw at any time. When SVB sold part of its portfolio and realized a loss of roughly $1.8 billion, it attempted to raise new capital. Instead, depositors panicked. Within about 48 hours, regulators stepped in and seized the institution. The 16th largest bank in America collapsed because of the same pricing mechanism we've been discussing all along.
If this video opened your eyes, make sure you subscribe, because what you learn today can save your future tomorrow.